What exactly is Wall Street up to? Dark pool transactions are on the rise, and if you don't know what those are, today we're going to need to discuss them together. As it turns out, Wall Street was making big moves on both semiconductors and other key markets. But could this chart hold the key? Are we really seeing a market that's about to crash through the floor, or are we still going to grind higher for some time more? Well, today we take a look at what exactly could be going on in the month of March for markets. Where are the opportunities? And of course, where are the pitfalls? Stocks, commodities, and cryptos? Let's cover it all right now. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro data and key levels for the week ahead, along with what exactly is going on with all these reds and where is the market flow going right now. As we've been discussing, it looks like we could be in for an up, down, and all around market, but luckily for you guys, there are opportunities on the horizon which could be superior. So let's talk about whether the month of February was exactly what you'd kind of expect. A little bit of up during the start and some selling near the end. Well, as it turns out, this is generally what happens when it comes to fund flows, and now we find ourselves in, of course, the first half of March. Is that a good point? Well, it can be okay with sometimes markets pushing up, but we've also got to be a little bit careful of the second half of March because, as you'll find out very soon, it's up, down, and all around during one of the more volatile months of the year. Now, of course, this does fit in with the general cycle of traditional years. If you have a look at the 1 + 4 + 10-year cycles and you overlay them, then generally what happens is we get a lot of chop, which we've been seeing so far, which is sideways market action, and then we tend to actually see a big resurgence coming off the back of March into the April period. Now, will that be the same in 2025? Well, let's take a look here at the Stock Traders Almanac, latest data when it comes to post-election years and what tends to happen in election years and post versus the traditional March runs. Usually it's kind of up at the start of the month, sell off, go sideways, then rally through to the end. Whereas in post-election years, it can often be a bit of a rally through the half, sell off, and then rally post-April. So if you're thinking about post-election years, we'd have to say that maybe we start the month kind of positively. And of course, that does have some stats with it that we always like to share here on the channel. 68% of the time, the market is up on the first trading day of March. And of course, that's what we're about to see as the markets open on Monday. So would you want to buy it? Well, there were a couple of big trades coming through, and yes, it looks like dark pools were on the rise. Now, for anyone that doesn't know what a dark pool transaction is, a dark pool is when basically two large institutions do a transaction with each other. One might be buying, the other one's selling, and instead of doing them through the normal market conditions and showing us in the level 1 and level 2 data, they do it between themselves, creating almost a secret style transaction that eventually does have to be, of course, shown to the exchange, generally at the end of the day. Now, when we tend to see these and they're massive in position size, if price action goes in the opposite direction or price action breaks a key level, that can be incredibly strong. And I'm sure you guys can see why that could be a pretty important thing to face. Well, let's have a look here at some of the biggest ones we've seen over the last week. The triple Qs, the U Pro, which is the ProShares Ultimate S&P 500, massive dark pools and a sweep right at the lows. And of course, huge trades here on 3 times levered funds such as the S&P 500 SPXL and also the TQQQ. Now, why is this key? Well, it's the reaction after these big transactions. As you'll see here on the S&P 3 times leveraged fund, as soon as these trades were going through, almost all of the algos started buying. And if that does break some key levels we'll talk about later on today's show, I think you guys could see why this may be an important dip. Could we go further? Yes, we could, and we'll talk about that soon. But it may be a little bit of a sign that maybe the market wants to push higher before it wants to maybe sell off later on. And of course, 2025 is one of the most dangerous years for all of us as investors and traders. So make sure to stay alert and, of course, subscribe to the channel as we'll be talking about together. Semiconductor bears also look like they closed positions on both the SOXs and the other funds. And we saw all of these basic giant transactions met with the same type of movement, a movement in the opposite direction, showing us that they were either the buyers on the leveraged bulls and probably sells on the leveraged bears. Let's now look at why this could be, and it comes back to us. It's the psychology of the market, guys. Something we really talk a lot about in our courses over at fxevolution.com. And of course, something that we always want to talk about here on the channel as well. How can it be that retail traders and investors, and it seems like everybody else, are so terrified by the market that we are literally seeing massive amounts of put volumes appear once again? And yes, I said that. Puts are really high right now over the last week in particular. And based on this chart here from macro charts, you guys can see that this is really accelerating. And what this is telling us is that maximum fear was achieved. Now, should that have actually happened so quickly? Well, we'll go into that soon. But just remember, whenever you're looking for maximum fear, you're also looking for other sectors to come with it. And one of those is traditionally financials. Now, does this look like a chart that you'd be terrified of right now? Well, of course, with financials just closing to an all-time high, doesn't really look like to me, or to you probably, that everything is panicking. And of course, this also means that the bond market, while moving a little bit quicker than it has, is still not totally freaking out. And this is the importance of being a bear or a bull in markets. You want to eventually gain a bias based on generally price action and what they're doing, not what they're saying. But at the same time, timing is everything. And breaking certain key levels is going to be the most important thing of 2025 when it comes to the S&P 500. Speaking of which, percentage of stocks down 20% or more, obviously accelerated throughout the last week. And this can also be a shock zone. As you can see here, during 2024, we just didn't see these types of huge moves in stocks so quickly because it was an easier year to trade. We've gone back instead to more of a 2023 style fear out market, or even a 2022 style market there. Now, this is really where it shows us that we are totally freaking out, or at least some people are freaking out. Retailers, when I say we, because most of us are less sophisticated than, let's say, the Wall Street algorithms. 60.6% of respondents, taking us to periods that we haven't seen since the bottom of 22, and also on top of that, 2009 just appeared with 150 to 200 point drop. That is absolutely unheard of. I have never seen so much fear be created so quickly in markets. And what this tells us is that generally you'd use it as a contrarian indicator. You can see here this latest Subo trade data basically says that even if we go a little bit lower over the next 1 to 2 weeks, the chance of the markets coming back the next month, 2 months, 3 months, and still having one of those last kind of V-shaped recoveries is kind of likely. And that's because when you see fear like this, usually we're seeing significant sell-offs across the board. Now, why could we be getting fear? Well, you guys have all seen this before. High PE ratios, clearly some types of issues that are happening right now with unemployment on the rise, and just in general, we're seeing weaker levels in the US 10-year, 20-year, and 30-year. And that's making people start to say, well, maybe we need to be a little bit more cautious when it comes to markets. One of the ways that people are usually more cautious is to look at treasuries. And treasuries have suddenly gone up since we looked at them about 1.5 weeks ago. Now, why is it so important? Because all of the price action led the way. If you look at the US 10, 20 or 30-year chart, which I highly suggest you do, we'll look at one later on today's video, but you should do it again for yourself and set these alerts. As soon as the major trend lines were taken, guess what happened? Treasuries started to move up. And why are they moving up, you may ask? Well, as it turns out, a lot of people are shorting them. Yes, it became one of the hottest shorts of last year, and everybody's been super negative on treasuries. All of a sudden, boom, we see a movement that started to push up. And while treasuries are not a trade, and we talk about this a lot on the channel, they are an interesting phenomenon of why price action leads the narrative and why you need to be paying attention to that more in 2025. Speaking of another interesting stat here, as you can see from Tom Lee, you've got the latest data from Nvidia when it comes to stock reactions post the earnings report and how it generally reacts. Now, yes, I know, guys, some of you groan about this, but in general, yes, he's of course going to be bullish and pulling bias stats out. But this is still an interesting one. Did you know that if you look at Nvidia 1 month post earnings over the 2020 to 2022 period and everything else, we are actually seeing generally a 70% track record of positivity and an average median return here of 16.4%. That's pretty wild. So it's actually been a post-action, that is post-earnings action buy on Nvidia traditionally. And what did we hit last week? We hit that 120 put, and straight away we see the dark pool transactions come out on semiconductors and start closing positions. That is a slight bullish positive action for the markets across the board. Now, if we hit the low, well, the only problem with the low right now is we didn't hit the 200-day moving average. Now, traditionally, we will hit this 100% of the time if we missed it the year before based on data taken from the 1990s to now. Now, that doesn't mean it's going to be a 100% chance, but 3 of 5 of those previous times happened in Q1. And obviously, even with these large dark pool transactions, markets can still move underneath and still find a lot of volatility around here. So the 200-day moving average is still an important level to look at for this year. US recession chance obviously is on the up in terms of people being very uncertain about policies and uncertain about geopolitical tensions, and that is possibly going to rise throughout the year as people just get freaked out by all sorts of push-pull dynamics within news and everything else you're reading. Again, if you want to be less confused this year, make sure to subscribe to this channel because we cut through it with data, with the facts, and obviously we look at it based on price action. Another thing with price action that we should be thinking about is a chart such as this, which is that treasuries are starting to improve versus the SPY. And guess what? This has happened every other time. So it's very important to note that this is usually a key point and turning and tipping point for treasuries where they start to perform better over the next coming months. And if we continue to see what we're seeing, it looks like a rate cut could be back on board from the Federal Reserve. And of course, we may still keep seeing these interest rates go down, especially the long rates, as people get concerned about growth. And speaking of growth, the GDP numbers coming out from the Atlanta Fed are showing a potential decline to a negative number. So we'll see how that all plays out as we go. No panic yet, guys. Of course, we follow the price. Speaking of other defensives right now, XLP versus SPY, obviously we've seen improvement there. We've seen all the insiders inside of the healthcare sector basically buying up their own stock, which traditionally has been very good for the defensive sector. And in general, this year, of course, we've been more defensive. We think that defensive sectors, particularly healthcare, is one of the more interesting markets of the year. And I think it's actually one of the best performing now as we look over the last 2 months. What about gold? That's been one of our other favorites. This is just another bullish chart for gold. Obviously, the amount of ounces being discovered nowadays for gold is less, meaning it's becoming more and more of a scarce kind of metal. And of course, that can help to push its demand. When it comes to the Bitcoin gold, I guess, if you want to call it that, it is not doing too well. Obviously, we did see a big wick, which we don't need to talk about, but we dropped key levels. We potentially opened up what we call a Wyckoff distribution. And for now, we have really lost all the sentiment in these particular cryptos. So remember, guys, it is maximum fear right now in the crypto market. And you can see this here as well as you look at the Ethereum versus Bitcoin charts. And the ratio is getting right in there with what has traditionally been a huge turning point for Ethereum versus Bitcoin. Will it be again? Well, certainly has hit an area. And we'll, of course, be needing to follow this. Now, as we mentioned before, generally when you're seeing a market panic, financials are one that goes. Home builders are one that goes. Well, we do know that home builders is doing pretty poorly, but financials are actually on the rise. And the breakout here has taken us to that all-time high. If you actually look at the last 5 days, financials are now the best returner, which is again a positive for the bulls here. And the defensives are also up there as well. But it's a very weird thing to see financials and the defensives both going together. Tells you that we could be going in from a mid-cycle to a late cycle, and the financials might be just looking for deregulation and, of course, corporate cuts. That is taxation cuts on the horizon. The S&P 500 filled the gap, which is one puny buy zone. But what really was probably the biggest tell here when we look at the charts has to be those dark pool transactions that came through on the lows. When we move over to something like the US 500 here and we look at the futures market, you'll notice there's a huge wick. That, of course, is bullish, guys, when you're looking at the overall wick action of the markets. Whenever you see this type of thing, you've got to say, well, that is what you really want to see if an algo or bid buys or excitement is coming back in. Remember, wicks do hold orders, and in this case, it's generally a pretty good sign that someone at least was buying up. And we clearly see it with those dark pools. What about the options themselves? Where did we close? What are we now seeing in terms of the options flow? Well, the big thing here is going to be 5,900. And as we've talked about, 5,900, a very important level from the put level. And we continue to see that throughout both the Monday trade and the Tuesday trade, with the Tuesday trade actually pushing a 6,000 with the massive amount of puts. So if the Wall Street kind of traders didn't want to pay out much this week, they would keep the market higher and they would keep it above 5,900, at least maybe even if it's sold off throughout the Monday session, they would try to hold it between 58, 50, 59, and then maybe even push it up, at least with the current information we've got here. Now, if markets do stay low, they do go underneath 59, just remember with this amount of puts through, there generally has to be a lot of hedging, and that could push us to the next levels. And anything under 5,800, which is the next level, that will be 57. So the key levels right now are 5,900. There's no doubt that is a big zone. And then we'll be looking for 5,850 and 5,800 in general. And if we break 5,800, I'd say 57 will be the next zone. What about Tesla? Well, that's of course been coming under all sorts of scrutiny. 280 was the put wall that we saw last week. It bounced off there, bringing up $13. And if it loses 280 anytime this week, remember 220, 240 is the next area. So Tesla's still in a downtrend. It hasn't seen enough bid yet to really say, wow, the buyers are back, but certainly it's been getting blasted. If it goes through 310, we will move from negative gamma into a positive gamma style situation. What about Nvidia? Well, Nvidia, obviously 120 was a big zone. 120 remains a big zone over the next 2 weeks. And really 115, 120 is where we've seen all of the previous buying. So we've got to remember Nvidia has a huge buy wall somewhere between 115 and 120. And it's currently trading at 125. If Tom Lee's stats held up, then we would move to a new all-time high in the future. But you've just got to remember that this area here is going to be very difficult for the market to get through. And if it does drop that zone, Nvidia really is looking incredibly bad. So just remember, this could be the most important chart other than financials to be watching this week. Let's now move over to where we see good value. Well, traditionally, you may not like healthcare companies, but they're actually looking pretty good. This is something we brought up in our private community. We do a macro class every Monday or Sunday evening in the US. And we obviously talk about this along with our live streams. And we've been bullish on it all year so far. Now, it's doing pretty well, and healthcare continues to look pretty solid when you're looking at the closes, the weekly, the breakouts, all of those types of things. So healthcare certainly is on fire, but it's also other things as well. If you look at XLP versus SPY that we had in a chart before, you'll notice the weekly closed very strongly, and this suggests that the market is starting to turn more defensive. One of our favorite reads on the markets is XLY versus XLP, which shows us the American consumer, and you can clearly see a shift from January to February with a downward move. What's that telling us? More defensive, more single stock picking style market, and potentially weaker returns on indices. So it's going to be more of a rotation style market. US 10, US 20, US 30 years all coming down to key levels. That's of course pushing treasuries up, and treasuries is already almost at that 94 bracket. So if you managed to buy this a week ago, congrats to you. Not a bad return. I mean, how much is this for treasuries? Probably only a couple of percent, but treasuries 3.4, that's not bad at all. Great wick here, and excellent, of course, buying pressure. Dollar index finding some buyers as it hits into the big key support. Remember, if it goes underneath 105.70 in the future, that's going to be a big trigger point. And gold has come back down, which we suspected it would. Now, if you know this channel, you guys know I love gold. I'm still incredibly bullish gold on the longer medium term. That means months into possibly even year or even more. But the problem with gold is it went too quickly, too fast, and everyone got bullish on it again. And we know we hate this. So 29.50 was our our sell point, and this was an exceptionally good sell point. So obviously we almost got it within the dollar an ounce, but we've come back down to a level that I would like to see gold hold at. It closed around here, and we'll actually dial in this week, so stay tuned for this, to see where the price action is looking good for a gold purchase. Now with gold down, silver obviously has to move down as well, and unfortunately we did not get a rebull buy on silver, but we'll be watching very closely as the price action dials in on this other metal. And I'd say that silver will have better upside next move up, and that of course will be something we're looking at. Oil, too tough to call. Still pretty negative overall. Obviously came into our day traded buy zone last week. I would say that the small time frames are bullish and the large time frames, of course, are still bearish. As you look here, long leg doji, a lot of weak rejections. But if we manage to get through 73.50 in the future, that is going to be ultimate bull for swing traders. It is the toughest commodity to trade this year. The geopolitical tensions are pushing it each way. When you see here, Tesla closes on the 50 exponential moving average, so that's obviously a key zone, but not quite down to where I would think buyers come in, 250, 220, that type of level. So we'll see how that plays. And Nvidia finding the most traded zone throughout last week's trade and finding massive transactions. All the bears closed. Look at this, guys. I mean, you just zoom that in. Bam, straight on the zone. So that is exactly where you would expect them to place large transactions. And obviously, when you look at something like semiconductors as the major market sector, you guys can see it's doing nothing. It's literally sitting up, down, up, down, up, down. I don't think we can make a clear case for which way this is going just yet. This is absolutely stuck. And that was a big trade hold for Nvidia. So it's important that holds. When we move over to HSI, the Chinese market's stagnating a little bit at the new highs. We're looking for 25,000 in the future. I would like to see a daily 20 maybe hit and then bounce off. You can see twice it's hit that level. So we'll see. It's not the biggest zone, but certainly one we're looking for. US 2K dropped. No real bid here. So the Russell 2000 not finding enough bid. And you'll notice that when you check it out on any time frame, there just isn't enough buyers here. By the way, if you have a look at the S&P 500, just to kind of really reiterate this, you're going to see that the S&P 500 has like a really strong looking trend line behind it that most bulls will probably be like nailing everywhere at the moment. So it's like this, and you can see it's hit once, twice, 3 times so far. I'm not sure if it actually goes all the way to the low on log scale, but generally speaking, this is the trend line that most people are looking at saying, oh, it's very bullish. In general, what we're really looking for here is dark pools, and we did start to see them appear, remember, throughout the Friday movement and action. What about NASDAQ? Well, it held its lows, hit the first support that we had on the charts, and this is a pretty good level to find bid buys. So again, Nvidia hitting a good bid buy level, we see NASDAQ hitting a good bid buy level, and we're also seeing, in general, what looks like some large gap fill dark pool transactions appearing on the S&P. And that's a good sign that maybe we're in for a bit of a relief here, and then possibly things get worse again, and then we hit the daily 200. That's certainly possible based on those previous charts we've seen for March and for normal post-election years, the 1 4 10-year cycle concept that we had before. But just remember, we still have to be inherently bullish unless you are prepared to stay out of the market potentially 6 to 12 months. Because there are literally a lot of bad signs starting to appear that we've gone through. Home builders, bonds starting to freak out, obviously defensive style moves that are happening, healthcare, staples, treasuries. There's so much stuff going on, but that doesn't mean it's going to just go boom and crash straight away. I saw Jeremy Grantham has put out his almost yearly bear call. Maybe we'll talk about that in our next video. Ethereum, this does not look like a great chart. Obviously, we see another steal level, another new low. A few of you guys actually said, oh, Tom, I think it's going to go new low. I would have thought it wouldn't have done this because, generally speaking, that Bitcoin chart looked a lot better. And these lows here were actually exceptionally good. They usually came with a lot of fear. They came with large dark pools. They came with all those types of things. Either way, are we in some kind of Wyckoff distribution? I think you could definitely argue this, and that's probably the biggest problem for Bitcoin right now. Even if it comes back, what's it do here? If we get through 100K again, wow, it's on. That is going to be a super buy. Things are going to be on. A lot of people are going to be caught off guard. But even with these resurgences, you've still got so many problems in the future. And that's the issue with losing a volume or losing a level like we did last week. So as Bitcoin comes back up, you can see here the weekly, large wick overall. Yes, it's done a little bit of kind of coming back, but it's going to need to do more to really regain people's confidence and regain that sentiment that needs to come back through. So crypto is going to be a case of let's watch and see. Let's see how it plays out. Have I dropped all of my investments? No, I haven't dropped my investments, but a few trades certainly did get wiped. And that's just the reality. Sometimes that happens, guys. You lose one, whatever. You've got a fixed risk on it. The risk might be, I don't know, could be thousands, could be $1, could be $10, could be whatever you want to put on it. So in general, you've got to expect sometimes you're going to take L's, but you have to look at it and say, would you do it again? And if the answer is yes, then it's all good. Now, of course, with our investments, gold, China, healthcare, those types of things, are they doing well? Yeah, they're doing pretty good. So you've got to remember it's a give and a take, and that's how trading is. You can't win every one of them, but we will be still watching, of course, what happens here with the crypto, and we will be watching the structure more than anything. As we always say, patience, react, don't predict. In this case, it's going to be, can we actually see a bid buy come back in? Now, in terms of this week ahead, the biggest thing really is going to be the jobs numbers. And you can see here the job, and Powell is coming out to speak after the jobs numbers this week. So this is the big one. Are we going to see a drop of jobs numbers? Are we going to see these Doge cuts or anything come through? I don't know. We'll see what's in there. Most of the time, the problem with non-farms, it can go off in one direction, grab liquidity, and then come back in the opposite direction. So you've got to be very careful with this number. It is going to be a big move. And this is now probably the most important number of the year, which is what is happening with economic stability in the US. Guys, if you enjoyed today's video, then remember to subscribe, smash that like button. We've got so much coming through this week that we need to talk about together. And do remember, if you're interested in finding out more about what we do, how we make these decisions, how we understand the cycle, and why I mentioned the other day that I'm pretty much done with new money investment for the time being, then you can check out our advanced masterclass. I think some of you guys would absolutely just love that. Of course, we do have some great reviews over on Google as well if you want to check them out. So other things that I guess I'd mention as well, follow us over on X this week. It's going to be a big week in terms of data, and more importantly, I think price action. If we keep seeing dark pools supported, that is going to be a good sign that markets can recover. But remember, 1 foot out the door. This year is not like any other. It's been a while since we've been in something like this. Margins up, people are up, going crazy all over the place. Leverage is actually huge across the board now. And as we can see, sentiment is shifting by the day. Thanks so much, guys. Bye for now.